Dear learners, till now in this course, we have learnt about basic concepts of financial management, that is also known as corporate finance. We learnt about time value of money, cost of capital, different sources of capital like owner's capital and borrowed capital. We have practiced numerical on time value of money, risk and return, and cost of capital. As you know, one of the core functions of finance manager or finance executive is investment decision. Now, this investment decision which we are talking about is not about stock market investment decision, that is buying and selling of shares. We are not focusing right now. That investment decision is the part of another subject, but under a scope of finance manager activities, investment decision basically means deciding about in which project funds have to be invested. As you know, companies keep on expanding their business, modernization takes place, diversification takes place, automation takes place, or sometimes companies go for the replacement of the old machine. All these projects, all these investment ideas qualify for investment appraisal. That means whenever a company is thinking for any kind of investment of their capital into different projects, definitely an investment appraisal has to be done. When we say project, a project is stand-alone activity of the business organization which can be identified separately from the angle of start and end, so that we can evaluate its profitability, whether it is financially viable or not. If I give you an example, let us say a company is right now operating in North India. Now they feel that they should enter into South India also, that is market in South India or southern part of the country. Then definitely entry into the southern part of the country is a separate project. How do we evaluate that project? Reason is that why it requires evaluation, because sometimes you might say we are right now selling product in North India, simply go and sell it into south of India. But remember, when you enter into a different market area, different market segment also, we always have investment in that segment. Certain money will be invested in the infrastructure, in the research activities, and then once we make an investment in the infrastructure, that is land, building, plant, machinery, training to the employees, hiring new employees for that area and all that, after that revenue will be generated. Sales revenues or revenue from services will be generated. Now, precisely investment appraisal means checking the financial viability, testing the financial viability of the project, whether a project is financially viable or not. It means to say, if suppose 100 crore rupee is to be invested in opening a new branch or entry into the new market segment, then definitely revenue will flow in year on year. It may be for 5 years, 10 years or lifelong. So our task under investment appraisal is just to testify whether the revenue generated against this investment is sufficient to cover our cost or not. Because if you remember, we have calculated cost of capital. If suppose 100 crore rupees is financed through debentures, preference and equity collectively, then definitely we will calculate the cost of that 100 crore. Let us assume after tax cost of that 100 crore is 15%. So our simple submission will be that whatever 100 crore is being invested in the new project, whatever 100 crore is being invested in the new project, that should give us the return more than 15%, because our cost is already 15%. And to add something to the bottom line, to add something to the profits, its recovery should be more than 15%. So year on year, return on investment should be more than 15%. So that is what we are going to testify, whether a particular project gives us sufficient return or not. So let us see what are the steps taken into investment appraisal methods and decisions. Capital budgeting is concerned with investment decision which yield return over a period of time in future. So capital budgeting is a process through which we evaluate the investment projects. Capital budgeting is the process through which we evaluate investment projects. Investment projects may be of different kinds. Replacement of the old machine is also an investment project. Opening a new branch is also a project. Launching a new product is also a project. So in that case, one technique which is called as capital budgeting or methods of capital budgeting help us in evaluating financial viability, financial feasibility of those projects. So investment appraisal basically means testing the different investment projects from the financial perspective, whether these are financially viable or not. So capital budgeting methods, so investment appraisal methods are alternatively called as capital budgeting techniques or investment appraisal methods. Therefore, first and the foremost requirement for evaluating such investment proposal is to estimate benefits or economic values. As I spoke few minutes ago, you are going to enter into new market segment which will require 100 crore rupees investment. So this 100 crore rupees investment is cash outflow, a departure or sacrifice of the economic value, 100 crore. It is costing you in cash. So definitely we are interested to gather the facts about how much economic value or economic benefits will flow in for the company. So there will be two concepts, cash outflow and cash inflow. Cash outflow means money invested by the company in new project, whereas cash inflow means cash received by the company year on year till the maturity duration or till the lifetime of that particular project. What are the different investment decisions which I spoke few minutes ago? Setting up a new branch, installation of a new machinery, replacement of an old machinery, new product launch, entry into the new market segment, and automation of the existing system. All these have to be evaluated from the angle of financial perspective. Because when we go for the, if I talk about the last one, automation, or I go for the second last one, which is entry into the new market segment or replacement of the old machine, all these things are being done to enhance the revenue, to boost up the revenue, to boost up the cash inflow. So therefore, what we are going to do for every kind of project, not this is the only an example, list is unlimited. So for every kind of investment appraisal project, we need to gather the facts, how much will be the cash outflow. We need to gather the facts, how much will be the cash inflow. And just to remind you, there is a difference between profit and cash inflow. So we will see that also. So these are the different investment decisions for which appraisal is required or application of capital budgeting methods is done. Now, quantifying economic benefits. As I said, every investment project will have some kind of economic benefits. So how to quantify those economic benefits? So economic benefits can be quantified in two terms. Number one term is accounting profit. That means profit after tax. So you can say if we start a project which has got a life of 5 years, every year it will generate profit after tax. And profit after tax, you know it very well, in accounting we calculate from all the sales revenue, all the expenses are deducted, even the tax is paid, and whatever is left as a reward after paying the tax is the accounting profit. And another term is cash flow. And precisely when we say cash flow, we are talking about cash inflow. We are talking about cash inflow. So there is a big difference between accounting profit and the cash inflow. Accounting profits get affected by certain non-cash items. And non-cash item is like depreciation, like amortization of intangible assets or fictitious assets. So copyrights, patents and all that get amortized. Tangible assets, land is not amortized, but yes, building, plant, machinery, they get depreciated. So all these are the examples of non-cash expenses. So after-tax profit gets affected by non-cash items. Similarly, after-tax profit gets affected by certain items like loss on sale of different assets or loss on so and so. It means we will be considering profit after tax only in one method of capital budgeting, but in rest of the methods, our main focus will be on cash flow. Now, why we are considering cash inflow? I have written it also. Which one is superior out of these two? So, superiority wise, cash inflow is superior. Reason being, when we are investing the money, our economic value goes away, or we are sacrificing the economic value right now in the form of cash outflow or by committing our cash into the investment. Therefore, to evaluate, I am getting to get the cash inflow or not, or do I get sufficient cash inflow which cover my initial investment as well as return on the investment. So always we focus on cash inflow generated from the new projects. So I have just told you it will be only one method in which we will be using accounting profit for evaluation purpose. In rest of the methods, we always use cash inflow. So cash inflow is superior as compared to accounting profit when it comes to quantifying economic benefits from a particular project. So I have discussed about accounting profit versus cash inflow. So economic values are the economic outflow, that is cost, represented by foregone opportunity to use cash, and cash inflow is benefit in terms of cash inflow. Because when we commit our resources, that means monetary resources in buying land, building, plant, machinery and all that, and apart from that, we invest something in the working capital also. Working capital means requirement of funds for day-to-day activities. That means to say, if we have commissioned a project, installed a plant which has costed you 100 crore and tomorrow plant will be inaugurated. So your 100 crore is already there in the infrastructure, and that investment in the infrastructure gives you capacity to work. That means capacity to produce goods and services. But question comes, do I need to invest more? Yes, you need to invest more, and that investment goes in the working capital, because you need some more money to buy the raw material, to pay for the day-to-day expenses like wages, salary, electricity, water and all that. So money getting invested in those activities is called as working capital. So we can alternatively say you need some more investment in the current assets. So both put together are the economic outflow. And then we measure the economic benefits in the form of cash inflow. So now cash outflow. As I said, cash outflow can be initial cash outflow and subsequent cash outflow also. Cash outflow means investment in a project. How much out of pocket you are investing in a project. When I say out of pocket, let us say you buy a new machine. You are buying a new plant which will cost you 20 crore rupees. So your investment is 20 crore. And if I say it is at time 0, so it will be initial outflow. Now initially capacity of the plant may be X, Y, whatever it may be. You have a provision for capacity boosting or enhancing the capacity subsequently also. So the same capital investment may be subsequently also. So initially you did the investment in fixed assets because plant qualifies for the fixed assets. Plant qualifies for the fixed assets. After 3 years, you need to augment the capacity. You need to enhance the capacity, increase the capacity of the same plant, and you have to spend 3 crore rupees more. So let us say in year 3, you are spending 3 crore more. So we can say initially we invested 20 crore rupees in the fixed assets, that is plant. At the end of third year, again we invested 3 crore. So capital investment in the fixed assets can be initially as well as subsequently, or it can be only initially, no subsequent investment. Similarly, you will have some investment in the working capital. That means your sum of the money will be blocked into inventory, your sum of the money will be blocked into receivables, that is trade debtors, because when we sell goods on credit, our money gets invested in the trade receivables. Some of the money will be blocked into prepaid expenses, all that will be there. So we will have some investment in working capital. So initially, let us say 1 crore rupee gets invested into working capital. So we can say initial investment in this particular project is 21 crore rupees, represented by 20 crore in the fixed assets and 1 crore in the working capital. Then comes subsequent investment. It may be or it may not be, but if it is there, it will be given to you. So we are saying at the end of third year, 3 crore rupees is invested in the fixed assets to increase the production capacity. Then definitely it may be another requirement that we need to invest additional money in the working capital. So let us say 0.25 crore is invested in the working capital, more investment in the working capital at the end of third year. So we can say at the end of third year, additional investment is 3.25 crore rupees. So cash outflow can be in two activities: fixed assets, land, building, plant, machinery. So if a company buys these assets, then definitely cash outflow will be there. Investment in the fixed assets can be initially or at subsequent stage, as I have explained. Similarly, investment in working capital can be initially and subsequently also. So that is the cash outflow related to a particular project. So in an examination question or in the practical life also, we have to identify if we are going to set up a new project, then definitely we need to identify cash outflow, initial cash outflow, subsequent cash outflow, and cash outflow in both the activities, fixed assets and working capital. We proceed further after having understood about cash outflow, how to calculate cash inflow. Let us proceed. Cash inflow. Cash inflow comprises of two things. As I spoke few minutes ago, profit is different from cash inflow. When we say profit, it is accounting profit, that is profit after tax. How much profit is left out after paying the taxes. However, cash inflow can be of two types. Number one, operating cash inflow. Number two, terminal cash inflow. Operating cash inflow is also known as regular cash inflow. Operating cash inflow is also known as regular cash inflow. So as the word says, operating cash inflow, that means cash inflow received from operating activities, day-to-day activities. And what are the day-to-day activities of a particular project? Producing the goods and services and selling the goods and services. So cash flow generating or resulting from the operating activities of the project are called as operating cash flow. And there is a small formula for that. Although I'll explain in detail also how to arrive at cash inflow, that is operating cash inflow, but a small formula is profit after tax plus depreciation. I have written only depreciation. However, it simply means all the kind of non-cash expenses, all the type of non-cash expenses. And non-cash expenses are the one. Non-cash expenses are the one. The expenses which are shown as an expense while arriving at after-tax profit, but out-of-pocket cash is not spent for that. These result only from the book entry adjustment, like depreciation. Because the moment we provide the depreciation, definitely depreciation is the result of amortization of the asset. It is resulting from book entry activities. We are not paying anything to anyone. If I take you back to the previous example, we invested 20 crore rupees in the fixed assets at 0 time. And let us say every year company applies 20% depreciation on the fixed assets. So first year's depreciation will be how much? 4 crore rupees. Now when in the very first year company shows 4 crore as depreciation, company is showing this 4 crore as an expense so that its taxable income gets lowered down. So they get the tax benefit because depreciation provides the tax shield or tax benefit. But is company paying 4 crore rupees to anyone while showing the depreciation as an expense? My clear answer is no. So depreciation is one of the prominent non-cash expense. Apart from that, different intangible and fictitious assets amortized over the life of those assets are also non-cash expenses. So therefore, while arriving at operating cash inflow, shortcut is there. Profit after tax plus all the non-cash expenses which have been shown in the income statement for arriving at profit after tax. So depreciation and other non-cash expenses. Then these operating cash inflow will come to you year on year. If life of the project is, let us say, 5 years, so every year these will come to you. If life is 7 years, every year these will come to you. It may be more in 1 year, less in another year, or in certain year it may be negative also. So that depends upon the sales revenue. But yes, year on year it will be there. Then comes the turn of terminal cash inflow. Whenever we make an investment, every new project, every plant might have a definite life, at the end of which either we need to renovate it or we need to surrender it, we need to sell it. So here in theoretical life, we are always given a definite life, 5 years, 7 years, 10 years and something like that. And at the end of that life of the project, we will get terminal cash inflow. So this terminal cash inflow will be apart from the regular cash inflow or operating cash inflow. So let us say life of the project is 5 years. So during all these 5 years, operating cash inflow will be there. But in the 5th year, apart from the regular or operating cash inflow, there can be something like terminal cash inflow. So this terminal cash inflow comprises of 2 things. Scrap or salvage value of assets. Whatever investment we did in fixed assets, land, building, plant, machinery, we will realize the sales value by selling those assets, by dismantling those assets, by disposing those assets. So that scrap value will come. And another will be recovery of working capital. The money which is invested in the working capital keeps into circulation, remains into circulation throughout the life of the project. So initially we invested 3 crore in working capital, subsequently 0.25 crore. So this 3.25 crore remains into circulation during the lifetime of the project. At the end of 5th year, project comes to termination. Then this 3.25 crore will also be recovered back. Reason being, now at the end of 5th year, you need not to invest same money in the inventory. You need not to pay for the expenses. So all that money comes back to you, comes back to the enterprises or firm. Therefore, recovery of working capital is the another aspect or another term in the terminal cash inflow. So terminal cash inflow might comprise of both of these or any of these or none of these, depending upon the situation. So cash inflows are 2, operating cash inflow and terminal cash inflow. Now this is the table I have created for you to calculate operating cash inflow. This flow you have to remember. We start from the sales revenue and we deduct cash operating cost. That means variable cost and fixed cost in producing and selling goods and services. So this will comprise of cost of goods sold, administrative expenses, selling expenses, distribution expenses which are paid in cash. Remind you, cash operating cost. It may be variable in nature, it may be fixed in nature, hardly matters. Once we deduct cash operating cost, we arrive at cash operating profit. That means how much operating profit in cash has been realized by the company. It is also known as EBDIT, earning before depreciation, interest and tax. Sometimes this is also called as EBDAIT, earning before depreciation, amortization, interest and taxes. That means depreciation, amortization of different assets, interest and taxes. These four elements have not been deducted. Depreciation, amortization, interest and tax. These four elements have not been deducted, still to be deducted. So before that, how much is my profit? This is also known as cash flow before tax, CFBT. Cash flow before tax. This is also known as cash flow before tax. Then from there we deduct depreciation charges for the year or amortization expenses on the different intangible and fictitious assets. Once we deduct the depreciation for the year, we arrive at profit, operating profit before tax. That means such profit which has been arrived at after deducting the depreciation. This is also known as EBIT sometimes. But yes, operating profit before tax, also known as earning before interest and tax. Then we deduct tax expenses. As you know, on every project, a firm has to pay taxes. So whatever is the tax for the current year's profit, that will be deducted. We will be reaching at operating profit after tax, or commonly known as profit after tax. Now, whatever amount of depreciation was deducted at that point of time, same will be added. Whatever amount of goodwill written off, patents written off was deducted at that point of time, same will be added at this point of time. So deduct all the non-cash expenses which were, add all the non-cash expenses which were deducted at this point of time. Now you will reach at operating cash inflow, also known as CFAT. So operating cash inflow is known as CFAT. So this is the way, by following a logical sequence, you can calculate cash flow after tax. Now always remember, in an examination question, it depends whether you have to complete whole of the sequence for all the years. Let us say life of the project is 5 years. So for every year we have to complete this step. If year on year sales and expenses are changing, then we have to make the calculation for all the years. And if year on year same level of sales is there, same level of expenses are there, then we need not to calculate it again and again. We calculate it once and we say every year same money will be there. However, pay the attention, year on year sales might change, expenses might change. So you have to calculate operating cash flow for every year of the project. Now it depends. Sometimes examiner might give you the sequence from this level, or examiner might give you straightway this value, operating profit before tax. It means these activities have been done by the examiner himself. You have to proceed the flow from the next part. And in some rare questions or in the easy questions in the books or examination, you are straightway given CFAT. So directly we will be using that. Our idea is that ultimately we have to reach at this particular point for calculating or for arriving at cash flow after tax. So that was the calculation of operating cash flow or CFAT. Now we see terminal cash inflow. Now terminal cash inflow will comprise of two things. Number one, salvage value or scrap value, and number two, recovery of working capital. Now how do we find out after tax salvage value? Ultimately, our purpose will be getting after tax salvage value or after tax scrap value. So whatever scrap value you realize, that will be there. So let us say we realize 10 crore rupees by selling the used assets. And now the moment used assets are sold out, we need to work out profit or loss on those assets. How do we find out whether we have earned profit on sale of old assets or not, or used assets or not? Simply, this salvage value realized will be compared with the book value of the asset. Now, what is the book value of the asset? Book value of the asset is the value which is shown in the books of accounts after deducting the depreciation. As you know, book value of the asset will keep on decreasing year on year due to application of the depreciation or due to amortization of the depreciation. So suppose an asset was purchased for 20 crores and so far 12 crore rupees depreciation has been provided till the date of sale of the asset. So we will say book value is 8 crore. We can take another example. Original cost of an asset was 50 crore. For past 10 years it has been into use and depreciation provided so far is 40 crores. So we say 10 crore is the book value on the date of sales. Now question comes, if salvage value is greater than the book value, then definitely company has incurred a profit on sale, and if salvage value is less than the book value, then company has incurred a loss. So on the date of sale, we need to compare salvage value and the book value. As you know, if there is a profit on sale, company has to pay the tax on that profit, and if there is a loss, company will get the tax benefit, tax shield. Reason being, this loss on sale of asset will be shown in the books of accounts, resulting into less tax payment by the company. So therefore, if we have to calculate after tax salvage value, use the scrap value realized. If you are paying tax on the gain, deduct the tax, and if you are saving tax on the loss resulting from the sale of asset, that will be added. And finally, you will arrive at after tax salvage value. It means out of these two, only one will be there. Either you will have gain on sale of assets or you will have loss on sale of assets. So one of these two might be there. Now, once we arrive at after tax salvage value, we go for the adding recovery of working capital. Whatever money you had invested in the working capital, you will get it back. Now, question may be silent that okay, initial working capital was 3 crore, subsequent working capital was 0.25 crore, and nothing else is mentioned in the question, and project comes to termination after 5 years. By default, recovery will be there of 3.25 crore. So whatever money is invested in the working capital, that comes back to the owner or that comes back to the firm. So that is how we arrive at terminal cash inflow. So for every project, we will be estimating cash outflow, which may be in fixed assets and working capital. It may be initial cash outflow or subsequent cash outflow. Then we will be estimating operating cash inflow and terminal cash inflow. So these are the basic things we have to do for every project. Now once these have been done, we will apply investment appraisal methods, also known as capital budgeting methods. So investment appraisal methods are categorized into two groups: non-discounted cash flow methods and discounted cash flow methods. Non-discounted cash flow methods means we don't take into consideration time value of money. As you know, money has the time value. That means value of money changes with the passage of time. So in these methods, we will not be considering time value of money. And what are the methods in this one? First is the payback period method, and second is accounting rate of return method. So we will be learning those methods also. Then second group of methods is discounted cash flow methods. Such cash flow methods, such capital budgeting methods in which time value of money is considered. So we will be applying time value of money in those methods also. So discounted cash flow methods are three: net present value method, profitability index method, also known as benefit cost ratio method, BCR method, and internal rate of return method. So these are the methods we will be learning. So in totality, we will be learning these 5 methods. However, there are many more methods also. So in this video, this much is sufficient. We have learnt about basics of capital budgeting techniques or investment appraisal methods. In the subsequent video, we will learn how to apply all these methods. Till then, keep on learning. Thank you. Wish you good luck.